Welcome to the Lend Academy podcast, episode number 154. This is your host, Peter Renton, founder of Lend Academy and co-founder of Lend It Fintech. Today's show is sponsored by Lend It Fintech Europe 2018. Europe's leading event for innovation in financial services is coming up on the 19th and 20th of November in London at the Business Design Centre. We have recently opened registration as well as speaker applications. You can find out more by going to lendit.com/Europe. Today on the show, I am delighted to welcome Chris Sugden. He is the managing partner of Edison Partners. Now, Edison has actually been around for several decades as an equity investor. And, Chris is the managing partner there now, and he's been at the firm for many, many years. I wanted to get Chris on the show because I've been hearing their name more and more, and they also won the Fintech Equity Investor Award at the recent Lend It Fintech conference. So I want to get Chris on the show to talk about his thesis, how he decides to invest, what his view of the fintech space is, in particular the lending space. We talk about some of his investments. We also talk about the role of banks and the impact that Goldman Sachs is going to have, and much more. It was a fascinating interview. Hope you enjoy the show. Welcome to the podcast, Chris.
Thanks, Peter. Great to be on.
Okay, so I like to get these things started by giving the listeners a little bit of background about yourself. I know you've been at Edison Partners for quite a while, but why don't you tell us, sort of what you've done so far in your career?
I'd love to. Thanks, Peter. Kind of an interesting way I'd like to put it is I was doing fintech before fintech was cool. Right. I actually joined internet billing and payment company back in the late 90s, pre-dot-com boom, but we were on the front end of that. And actually that was when rendering a bill on the internet and allowing someone to click a pay button was pretty novel. Mm-hmm. But like so many things we see even today in fintech, adoption curves were longer than we all thought. But long story short, that company was called Princeton Ecom, and eventually we grew it from just a couple $1 million in revenue when I joined to north of 40, and we sold it for what we call a pretty good outcome, particularly given that we went through a boom and bust cycle, pre 9/11, pre Y2K, and sold it post all of that. But So I've been doing fintech for quite a long time. My 16 years at Edison, I spent most of my time, probably 90% of it, in the fintech space. And I got to the venture capital, growth equity, private equity landscape in what you might call a little bit of a unconventional way, having been a CPA to start my career and doing a couple startups in the CFO, COO track. And when I joined Edison, it wasn't clear I was going to be an investor and managing partner 16 years later. I was thinking I might be an operator someday, but joining the firm to sort of look at their companies and look at new deals with the partners here. Lo and behold, it's stuck, if you will. And now 16 years later, not only running the firm, but doing lots of fun and exciting deals. And I would say, I have one of, if not the best job in the world, meeting entrepreneurs who are going to change the world or make their dreams come true, or a little bit of both. So spending your day listening to those kind of folks or having conversations with them certainly is an exciting business.
Mm-hmm. Sure. So then can you just tell us a little bit about Edison Partners? I know it's been around for quite some time. You're not one of the founders, right? Or not the founder.
That's exactly right.
Yeah. So can you tell us a little bit of the history and background for Edison Partners?
Sure. I'd love to. The firm actually was founded in 1986. So it goes back and has really been around, right in the same kind of length of time or tenure as some of the preeminent brand name firms in the industry. Mm-hmm. Always a bit unconventional that it was sitting in New Jersey, not thought of as a hotbed of venture or growth equity, but here we are 32 years later with much success. And as you said, the firm was actually founded by a gentleman named John Martinson, who about 5 years ago, myself and a couple of other partners bought him out and now are running the firm, again, called Edison Partners. Back in the day, it was Edison Ventures. So the firm has been known for a long time as a venture capital firm. And about 10 years ago, we shifted to more of a growth equity strategy. And there's a couple of interesting tidbits about that. Growth equity is very, very sort of wide definition. You have some LPs, limited partners, who think about growth venture versus growth buyout and everything in between. And you have funds as small as ours. Our last fund was about $275 million. Our next fund will be just over $300 million. And the long story short there is we're at what I would call the smaller end of growth equity, both in terms of companies we invest in, as well as fund size, because frankly, growth equity firms are calling themselves growth equity and doing deals that look a little bit more buyout-like with several billion-dollar funds. Mm-hmm. But the long story short is Edison, as even a venture firm, always had a couple $1 million of revenue, sort of a dogs eating the dog food kind of thesis around it. East Coast entrepreneurs, frankly, we may get into this later, but the difference between East and West Coast entrepreneurs, having been doing this for over 20 years in the startup world and also in the investing world, I think the general sort of theme on the East Coast is we'll go build a business and we'll think about raising capital later. So you have this bootstrapping mentality that even to this day sticks. And so Edison had created a niche for itself, really a Northeast kind of firm, DC up to Boston, 30 some odd years ago, looking for companies doing $1 million or $2 million in revenue and investing a couple $1 million checks. And over time, we've gotten to be a little bit bigger fund and also now investing in companies that are a little bit more mature. So our sweet spot in what we define as growth equity are roughly $10 million checks, first check sizes, in companies doing roughly $5 to $20 million in revenue. And to tighten that up a little bit for you and your listeners, $8 to $12 million for us is a proxy, revenue that is a proxy for the dogs are eating the dog food. The customers really see a repeatable use case that we can scale a sales and marketing model around. And our capital comes in at a time when the companies haven't raised a whole lot of money. In fact, when we say Series A, sometimes our limited partners look at us wondering if we're a venture capital firm. But for these companies, believe it or not, it is often a Series A investor in that it's the first money they're taking in, but yet they've gotten their company to an $8, $10, $12 million revenue run rate by bootstrapping and selling customers on their solution. And to tie that off a little bit more, kind of the history and the evolution, as I said, we were DC up to Boston, and now we've extended into the Southeast and out to the Midwest, and even a little bit more towards the West, but more Texas and Utah and Colorado as far as states go. But one of our core sort of strategies, if you will, or differentiators is we've been investing for a long time in underserved markets. So proud to say, if you will, that about 25 to 30% of our deals have been in the New York metro or Boston area. We haven't done any Silicon Valley deals in our history. And so that leaves a lot of territory that we've covered in what most are calling underserved markets. And it's kind of been a hot topic, recently in the popular press or media. But long story short, we have 2 active deals in Atlanta. We have an active deal in Nashville, 3 active deals in Ohio, a couple in Columbus and 1 in Cleveland, 2 deals in Chicago, just to give some sense of that, 1 deal in Dallas. So I don't think really define these regions by state as much as you do sort of, big cities and even mid-sized cities, but pretty proud of the fact that we think we bring a value add, which we call the Edison Edge, to the table that allows us to bring an ecosystem with us besides our capital. Lots of investors talk about value add. Maybe we'll have time to talk about that, even though this is more about fintech. But long story short, really proud of the fact that we not only are talking a good game about underserved markets, but we've actually been in these markets for quite some time.
Right. Okay. So then what about industry focus? I mean, I know that, you said you've spent a lot of time in fintech, but the firm as a whole, I mean, how much of your focus is fintech? How much of your focus is other verticals?
A great question. Probably if it was only my way, we'd do 90% fintech because I love the space so much. I think there's so much to do. But we do cover 3 verticals, but you'll see a bit of a theme where some of these overlap. So we do healthcare IT in addition to financial technology, but it's easier to say what we don't do in healthcare IT. We don't do any biotech. We don't do any drug discovery. And then our third vertical or industry area we talk about is more enterprise. So we talk about verticalized SaaS as well as security and mobility as the key themes in our enterprise solutions. But interestingly enough, and as you well know, we may pull this apart a little bit, or dive a little deeper as we talk. But healthcare, for instance, and you look at revenue cycle management or payments in healthcare, a lot of fintech going into healthcare now, i.e. from a vertical specialty kind of area. So being deep in fintech, I think, has made us better investors in a couple of other enterprise or healthcare areas, and vice versa. If a company is doing a payments capability for the healthcare space, it helps to have real deep healthcare roots and knowledge. So we are seeing, I'll say, blurring of the lines among those 3 sectors, but those 3 sectors are where we spend our time. From a fintech percentage perspective, historically, it's been right around 35 to 40% of our deal count, if you will, logos, as they say. And it's been actually slightly larger than that, probably closer to 40%, the higher range of that, not higher than that, but the higher end of the range of that on dollars. Mm-hmm. So it's obviously been our most important. Every fund, it's been our most active, if you will. Most important is probably the wrong way to put it, but most active area.
Right. Okay. So I want to talk about some of the investments you've made. Maybe let's start out with MoneyLion. I had Dee, the CEO and co-founder of MoneyLion, on the show a few months back. Well, it was last year, I guess now. But anyway, tell us a little bit about that company, what you saw, and how that what made you pull the trigger there.
Yeah, thanks for bringing that one up. We're really excited about what Dee and his team are up to. And I know we may talk about another lending deal and lending in general as a fintech topic here as we talk a little more. But MoneyLion, interestingly enough, has a lending platform, but it's far more than that. Mm-hmm. In fact, I give the company credit for using this sort of a rebundling term. I know it's out there a little bit in the press or in the media, but from my perspective, I think MoneyLion has sort of captured the essence of bringing all the banking services back together in a mobile-first application. So you look at the company having a PFM that's as powerful as any other in the market. You look at having a credit solution as powerful as any in the market, a credit or lending solution as well. And back just a few months ago, towards the end of the year, beginning of this calendar year, we launched MoneyLion Plus, mm-hmm. which includes now a robo-advisor. And I think what they've done is really revolutionize the way I think fintech is going to be delivered to the consumer, i.e. all the services you want in one package with a subscription model, which is pretty revolutionary. That was not necessarily the thesis, as all great entrepreneurs, they either pivot or add or innovate. We had it more visionary when we invested in the company about a year and a half ago. We knew that's where we might take it, but both technology had to catch up and we had to continue to expand our capability at MoneyLion. But really excited about that. But what makes the company, beyond the rebundling aspect, really special, their use of machine learning and AI being two, I know, way overused cliches almost now, is pretty extraordinary from the standpoint of, from an underwriting side of the business, as well as from an origination side of the business, finding customers, if you will. The big challenge in lending is both of these being truly technology driven. I can tell you MoneyLion is absolutely 100% technology driven in those aspects. But what's really interesting, and we've seen this in this MoneyLion Plus launch, is the thirst, if you will, for the consumer to have all the capabilities they need or want when they need or want them. So the idea of the subscription is you can pay for really the access to a credit line. And what probably won't be lost on your listeners, but sometimes we wonder if our consumers are going to hear this messaging right. If you think about the private bank for the masses or for everybody else, high-end customers can get private banking services at some of the best known banks in the world. Mm-hmm. Everybody else is stuck without those kinds of services because your local bank branch won't necessarily offer those to you. MoneyLion Plus does that in a subscription form. And what really has been interesting in the first 6 months or so post MoneyLion Plus launch is the thirst to invest combined with the desire to make sure, in case there's an income shock, they can get access to a credit facility. And at the risk of sounding negative towards any other businesses, so I don't mean to sound that way, what I have always thought, and I was out front, invested in another deal in the lending space over 8 years ago. I'm a fan of the lending space because I think there's so much disruption that is still to come in the space and has come already. You're seeing the robo-advisory world, and be careful not to paint too broad a brush, but if you don't have a credit solution, you're a long way to monetization for your business model. So it's one thing to provide a really interesting service to a customer. It's another thing to be able to monetize that for your investors and shareholders and really grow a great business. And I think you're starting to see a few of the robo-advisors, at least this is the buzz that I hear, trying to figure out this whole credit side of the balance sheet, if you will. And in our opinion, what makes MoneyLion Plus extraordinary in terms of an opportunity for consumers is you can have your asset and your liability part of the balance sheet together under one view and help with those shocks that so many consumers happen to them and during the course of the year, have those taken care of and not get hit with big bank fees. So that's from MoneyLion in a very quick nutshell. hopefully I didn't go on too long because it sounds like too much of a plug for our investment. But it's really an exciting business, and I think they've really started to turn some heads with this Moneyline Plus offering.
Right. No, I wrote about that when it came out, and I think it's a really interesting new development that, Moneyline. I love companies that sort of thinking outside the box and sort of, breaking new ground in ways, in offerings for consumers that they're not following a well-trodden path. They're sort of really are doing things their own way. So I want to move on though and talk about another. I think you probably alluded to it. BFS Capital is another one, another lending platform. I mean, it sounds like it was a while ago that you invested there. But can you just tell us a little bit about that company?
Yeah, the company, the sort of arc, which we've seen with a couple of the public companies, certainly On Deck and Lending Club, more in the realm of On Deck than Lending Club in terms of what BFS is today or was even back then. But frankly, started out closer to the sort of, it was known more as of a merchant cash advance company, although when we invested, we had already seen some of the data around the small business loans that were beginning to take off. I would say one of the things that sort of underlying my investment thesis, both with Moneyline and BFS Capital is, and maybe I wasn't smart enough to be out there kind of, pounding the press with this, but I always was a bit dubious of the exchange or marketplace model because while you say you're taking risk and moving off of your balance sheet, at the end of the day, those buyers of those loans aren't going to show up at the exchange or marketplace if you're sending in bad credit. And with both BFS and Moneyline, what I really like about, and have always liked about both businesses is, you sort of live and die by your ability to find new customers and write great loans for your customers. And I say write, obviously technology driven, but you get the idea. So BFS is sort of the traditional, so to speak, but with quite a bit of technology around underwriting specifically. On an origination side, it's a combination, classic, if you will, ISO merchant acquisition model with partners, but also a direct model as well. And what's interesting is, like I said, starting as a merchant cash advance company, the company's now almost 15 years old. We invested in about 8 years ago. The company's really done a nice job growing into and over the time of our investment being truly a lender from kind of end to end, small advances in that 5 to 10,000, but more 10,000 range on up to several $100,000 loans for small business. Mm-hmm. And although we've seen this sector have a few of its own challenges with some of BFS's competitors, I think we've seen, for lack of a better way to put it, a little bit of a settling in or resetting. Another colleague in the investment space sort of said it looks now that Wall Street has sort of reset valuations to look less fintech and more financial services for a couple of the other lenders. Mm-hmm. I think that's probably fair. It may overreacted a little bit, but it's probably because there was a little bit of too much exuberance for a couple of the original IPOs in the space. And now it's probably like so many things on Wall Street and financial services, it probably swung too far the other way. Somewhere in between is probably the right answer because there's a ton of technology in a company like BFS. We've done a couple of acquisitions over time with BFS. We continue to be in an aggressive growth mode. We also launched a company that's owned by BFS Capital called Boost Financial, and Boost is our UK subsidiary. And so we do have additional global sort of aspirations as we continue to build BFS over time. Long story short, what I love about the on-balance sheet model is you have to have real conviction around your underwriting and your models. And the good news is when you get it right, the business model is a very strong one. Obviously, when you get it wrong, you pay a heavy price. But so far, I'll knock wood to say my biggest plug for BFS is having been profitable really consistently over the time of our investment, which is a uniqueness in this space, as you know.
Mm-hmm. So I want to go back to something you said just a bit earlier there. You were talking about like the online lending space still has some innovation to come. I can't remember exactly what the words you used, but I'm curious when you look at the online lending space today, it seems to be, I mean, it was overly exuberant, a few years ago, and there was so much money coming into the space, but, some of those, the weaker companies have already gone away. And I'm curious what you think of the space today. And when you say that, you think there's more to come, what you're actually talking about when you say more innovation to come.
Yeah, so I think, you've seen a couple of, even with, the most recent IPO, just last week, where you see, partnering up with merchants to provide home improvement loans right there at the point of sale or provide credit to consumers. I think there are angles or aspects like that. If you actually look at the healthcare space, we're mentioned before the convergence before, as we continue to enter a world of patient-centered healthcare, centered, by the way, not only in your actually wellness, but your need to cover your own costs and understand how your health plan works, because it's no longer won't be as much employer-owned, not just because we have government involved, but in general, the patient's going to be more in charge of their own healthcare. And so we saw a wave of electoral election type surgeries or procedures, see financing options, whether it be cosmetic or dental or some other. That was one wave. I think you're going to see another wave, frankly, around the healthcare space that will provide a need for lending and credit solutions. So I think what you'll end up seeing is call it vertical or specific niche type lending applications. We're looking, frankly, at the logistics space as an example. We think there's a pretty interesting opportunity where you see a space that hasn't had necessarily a ton of innovation, has some capital constraints, has, frankly, thin margins, but you're seeing an opportunity to grow if there was a working capital availability for those businesses. So I think what you'll see is less these, for lack of a better way, grandiose kind of consumers will now transact their loans online, which is a very huge opportunity and a huge game changer from a B2C perspective. If you look at it from a B2B or B2B2C perspective, there are niches where credit is required or working capital constraints could constrain growth or slow growth down, that we see opportunities that we continue to sort of probe into. So I would hesitate to mention a name on a podcast that we haven't done an investment in yet, but I would say from our perspective, the logistics space is one we're digging into pretty hard because we think there's an opportunity there as an example, if you will.
Right. Okay. So then what about, look at a company like Goldman Sachs that has, they've become very aggressively moving into not just the lending space, but, they plan to really have a major banking operation with many different, consumer-facing offerings. So how does that sort of play into your thesis when you're looking, not just companies like Moneyline, but the sort of, consumer-facing, fintechs in general? What do you think the impact that Goldman Sachs is going to have on this space?
Well, I think one of the things you could say from a purely, I guess when you're in my business, you definitely live in the half full optimistic world because entrepreneurs are trying to do things that haven't been done before, and millions of people or hundreds of people tell them it's impossible, right? So when you kind of look at that from that perspective of a Goldman participating and with a Marcus type offering, just go back. It wasn't all that long ago, I guess for guys your age and mine, that Goldman the last thing they would have thought is about being a bank, right? And here they are. Obviously, the credit crunch, the Great Recession caused that to happen. But to their credit, you look at how they've evolved and sort of embraced, wait a second, we have a huge balance sheet. We ought to use it to grow our business. I think the real question for, as you said, other fintechs we look to invest in or other companies that are looking to disrupt either lending, investing, wealth management, et cetera, you've got to keep an eye on what Goldman is up to and the kind of customers they're looking to attract. I personally would say the market they appear to be going after so far is at a higher credit rating, if you will, or at a higher end of the income spectrum than a Moneyline customer. But that's not to say there won't be some merging or blurring of the lines. It seems to me, and this is, knowing enough maybe to be dangerous or then some, the SoFi customer and the Marcus Goldman customer look a little more similar than the Moneyline customer and the Marcus customer, is my opinion. But that doesn't mean they can't shift gears and sort of move into our market as well. So I think from that perspective, a firm like Goldman, putting their muscle behind an opportunity. And frankly, I think, we can look at it and say it's taken them a couple years to really decide that they want to come after this market in a big way. I don't know if that's been more of a comfort with the regulatory environment or a comfort with their own business. But I will say it feels now in the last 6 or 9 months to be an effort that's not just sort of a hobby, if you will, for Goldman, but something they really look to grow. And hobby may sound too negative, but you get the idea. It feels to me like it's here to stay for Goldman as a real business. So I think from an investor's perspective, we have to understand what they're up to, where they're going. So far, it seems to be pretty it seems to be away from their capital markets and trading and investment banking business. Of course, all banks want to have cross-sell opportunities, so I'm sure there'll be some impact there. But we have looked across the spectrum, even though we spend a little bit of time here on lending. We've done capital markets, we've done wealth management deals. I say capital market trading, technology investments. There you always look at Goldman more as a customer, as a prime broker, as another participant in the supply chain, if you will. Mm-hmm. So I see less of Marcus in that realm where we invest and more in the, let's call it the lending and the other consumer financial services areas.
Yeah. So what about banks then in general? Because you've got some major banks are really, they're paying attention. I mean, Goldman Sachs is obviously, a very high profile company. Everyone pays attention to what they're doing. And I think you've got companies that have long histories of consumer banks, and they look at what Goldman's doing and they think, well, what are we don't have what they're offering. Why? So I find that, we had at Lendit, as I've said this before, that we had so many banks come. We had more banks than ever before, more than double the previous year. And I just see, when I look around, that banks are paying more attention than they ever have to the fintech space. And I'd like to sort of get your perspective. What are you seeing? Do you feel like banks are really going to be, acquisition targets for some of your portfolio companies, or how do you view the banks in general?
Yeah, so I actually think, like all aspects of technology and call it venture and growth equity investing, the strategics are in need of great innovation, great entrepreneurs as anybody else. So what's interesting about financial services and the banks themselves, historically, they've been okay acquirers, but not overly aggressive, a lot of build it here kind of mentality. And hopefully that, again, doesn't sound too negative, but that would be sort of a generalization folks in my business would say. I think you're seeing in the last 5 years, maybe a little longer, maybe a little less, an appetite for bringing innovation in, as all the way from fully baked, companies that have scaled to acqui-hire, to bring in talent that understands what a fintech actually is, right? What a blockchain actually is, needs to get inside banks. So in my opinion, yes, there's much more of a collaboration partnership going on than there is competition. I think, let's face it, I think 5 years is probably even going too far back. I don't know there's even the last 3 or 4 years where you'd really say the banks have embraced really the need for keeping pace, if you will. And of course, the banks would say, no, it's been more like 10 years. But if you really look when they got involved with real effort behind some of the, again, either wealth management or a blockchain initiative or actually an alternative lending initiative, you see them coming much later to the party, but now they're here for certain. I think there's still a big struggle because they're big targets. They've got a whole different regulatory regime than a financial technology fintech would. So from my perspective, it's still good to compete with banks as a smaller company because of the ability to be nimble. The other part is, frankly, let's just face it, architectures are quite old inside a lot of the banks. And so they have to acquire or do something new to really offer financial services in a way that a fintech can. I sort of go back to Moneyline, and you look at all the capability that sits right on your phone inside a Moneyline Plus account, and to get all those same services in one offering at a bank is nearly impossible. Forget about even seeing a wealth manager on the same interface as you do your home banking screen, as something as basic as that. Even signing up to be a customer, if you're going to a large wealth management firm to be a customer for a mortgage or a credit line, you've got multiple different contracts to sign, applications to sign, et cetera. So unifying all that, we're still in the fairly early innings of that. And so I think there are both niche opportunities for fintechs to sort of solve some of those problems, and there are much more sort of grand, like a Moneyline would be, which would be to sort of solve an entire part of the population's need for both credit and investing. But to circle all the way back to the banks, look, they have great trust for the most part. I'd say trust by the consumer base. Although the consumer base still thinks there's, from a fees perspective, there's always a wonder, is my bank really my partner or not? But a trust in terms of your money being there, not losing your money, et cetera, that's a huge asset. The brands are a huge asset. I think you're starting to see a few separate themselves from the pack, and I think we mentioned one already with Goldman. And so in general, I think the simple answer is they're more partners and allies in this race to really revolutionize financial services than I would say on balance are enemies, so to speak, or ones we worry as much about as other financial technology innovators. That's their size is always a challenge. Their ability to borrow money for, next to zero, obviously in a rising rates environment that may change a bit. But the point is those balance sheets need to be activated. And I think the technology partnerships that they create are a way to do that.
Right. Okay, well, we're almost out of time, but there's a couple more things I want to get in here. Firstly, what does a company have to do to get on your radar, or not even that, to get you to open up your checkbook? What are the things you're looking for, and how has that sort of changed over time?
So the over time part would be a firm strategy, being a little more mature of a company in I say old days, 10 plus years ago, a couple million, 2 million in revenue run rate would be right in our sweet spot. Now we're in the 5 to 10 of run rate revenue. So we do want to see some customer traction. And actually for us in fintech, that can be a challenge at times when you have a two-sided marketplace. When you think about payments applications, even what I used to do at Princeton Ecom, where there's a billing and payment solution, adoption takes time and you got to build the marketplace up. That in mobile payments was also a challenge for Edison and me personally over time. But in terms of, that's one is traction. Growth would be the other. We don't do turnarounds and we don't do sort of, if I just had a little bit of capital, I'd be growing fast. When entrepreneurs say that to us, it usually doesn't go very well, or the conversation doesn't last very long. So I think growth in some respects trumps all. As it relates to specificity around fintech, as we've talked about, I've invested in lending companies, and as a firm, we've invested in those. We've invested in compliance companies. We've invested in wealth managers. So we're across 4 or 5 of the big theme areas within fintech. So there's not really a specificity for us in that space. I would say from the perspective of fintech specifically, which your listeners most likely care most about, my view is you do it right from the first time. The compliance and regulatory regime is obviously evolving, and we all have to be very cognizant of things can change in an instant, just like we've seen with even ICOs having their own challenges now with are they securities or not. The bottom line is a regulatory compliance culture inside a startup is critical in fintech from the very beginning. Cutting corners early leads to bad outcomes late. So I'd say as it relates to fintech specifically, a high degree of trust and ethics may sound so obvious, but we all have seen the stories where that's not always the case. So growth, high gross margin are the basics, the high ethics, and the sort of regulatory sort of awareness and adherence is absolutely critical that runs the culture. The idea of a big, super big idea, we don't just invest in companies that are multi-billion-dollar markets. Quite honestly, we're okay if there's a $500 million or $1 billion market where we believe we can build a $50 million or $100 million company. That's all about getting in at the right price and being capital efficient. So capital efficiency still in my world has its merits in a pretty big way. So I'd say generally speaking, you'll see us take on opportunities that may feel or look a little bit more niche, but related to partnering with an entrepreneur. If you're in at the right price and you sell your company for $200 to $300 million, everyone can make a lot of money in that situation. So it's one of the issues with the current cycle is it's $1 billion or bust, and this whole unicorn term has created what I call vanity metrics. And I'm sort of on the soapbox for whoever will listen. Vanity metrics being how much money I raised and what my last post-money valuation was, as opposed to how much revenue do I have? How many consumers do I have actively using this solution? What is my customer acquisition cost to lifetime value ratio? And does my business model actually work? So entrepreneurs who really know their business model and the gears that make their model come together, those are the ones we like to spend time with, because they're the ones who are theoretically and practically scalable, if you will.
Mm-hmm. Okay, right. So last question. What are some of the interesting trends that you're looking at now that you think will really make an impact on fintech over the next couple of years?
Yeah, one that it's probably been now has a little longer run for Edison, because we've made a couple investments over the last 2 funds. In the compliance space continues to have an interesting opportunity for us. And whether you combine that with regulatory compliance and transparency, to us, that's an interesting area. We've seen sort of KYC and AML solutions really take off in an era where you've got to have active monitoring as opposed to sort of passive, if you will. So we continue to think the compliance space has some significant runway in it. And a second one, and I could go on for 3 or 4 more of these, but a second one in the interest of your time, if you will, and your listeners' time, is sort of, we all talk about big data. I'd rather talk about the right data, but alternative data and data-driven decisioning, that goes from trading, that goes to insurance, that goes to underwriting, as we already touched on in the lending space. I think we're just at the very early days of alternative data, and call it the right data, that's really going to revolutionize places where decisions are being made, whether it be credit for consumers, credit for businesses, or it be insurance underwriting, et cetera. There's a long, long way to go. We touched on MoneyLion many times in this podcast, but the point is the data that consumers can bring to the table to allow us to make better credit decisions. The credit bureaus are evolving and need to evolve even faster, but there's availability of data where we don't just underwrite a customer either at BFS or MoneyLion based on a credit pull from one of the bureaus, but we have our own data set to help us make those decisions. We think the whole credit space is really interesting, and we actually have a couple of investments in that space. One that's really interesting is a company called Predata, and Predata is an alternative data provider for both government intelligence, if you will, but also for the financial technology relative to trading, using alternative data to understand government risk, political risk. They have something they've called the PVIX, the Political Volatility Index. Really unique. Bloomberg publishes it, so you could trade the PVIX, but more importantly, you could use the PVIX to guide you to know where your supply chain might be at risk, or where oil prices might go, or other commodities might go. So we think the data space, and again, I hesitate to use the word big data, it's much more the right data, if you would, to really address some of these opportunities.
Mm-hmm. Okay, fascinating. Well, we're going to have to leave it there, Chris. I really appreciate you coming on the show today.
Peter, likewise. I really appreciate you making the time for me, and it was a pleasure to talk to you.
Okay, see ya.
Have a good day. Bye-bye.
Bye. You know, I too am a big fan of alternative data and data science in general. I feel like it's an area that is just getting going. We're already making tremendous strides, but I look to see, down the line, the impact of having all this phenomenal, not just access to data, but the ways to analyze it with machine learning and artificial intelligence. I feel like this is an area that is going to go a long way, and we are, I feel like we're going to expand access to credit. We are going to be able to combat fraud and many other things, some of which I've written about in the past. But I feel very excited when I look at the strides that we're making in the sort of data analysis, data science space. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye. Today's show was sponsored by Lendit Fintech Europe 2018, Europe's leading event for innovation in financial services. It's happening November 19th and 20th at the Business Design Centre in London. Registration is now open, as well as speaker applications. Find out more by going to lendit.com/Europe.